Hello, I'm David Frazier with Investors Monitor, and this is our daily Market Insights show where we strive to tell you everything you need to know, but nothing more, regarding factors and developments that are likely to impact the value of your investment portfolio. We're recording today's show on Tuesday, September 1st. And as I'm sure you probably know, U.S. stock prices, as well as stocks around the globe really, fell fairly sharply again today on Tuesday, September 1st, with the Dow Jones Industrial Average declining by 470 points, or 2.8%, and the S&P 500 index falling by approximately 3% today. And if you tuned into the mainstream financial broadcast show today, you probably heard what you've heard over the past couple of weeks and what you'll generally hear on these types of shows, and that is that supposedly the U.S. economy is in good shape and is growing at a healthy rate, and that the recent big drops that we have had here in the United States are due to an economic slowdown in China. But as I commented on all of our past shows, my research indicates that that is a bunch of nonsense, and that's not what has caused stocks here in the United States to fall. In fact, as I've mentioned on our past couple of shows, or at least on one of those shows, the statistics that I review, or certain statistics that I review on a regular basis, clearly indicates that institutional investors, and that is, the big pension funds, mutual funds, insurance companies, the entities that really determine in any given environment the direction of stocks, that those institutions reduced their allocations to growth stocks and cyclical stocks during both July and August, and increased their allocation to so-called defensive stocks, stocks of companies such as in the consumer staples sector or the healthcare sector, stocks of companies that tend to fall less than growth and cyclical stocks during economic slowdowns and stock market downturns. So even though money managers at those institutions have been telling investors over the past couple of weeks not to worry and to continue to hold on to your stock positions, just to stay diversified, and that stocks will soon rebound. Very interesting that the institutions that employ those money managers have became more defensive in their stock market allocations during each of the past 2 months. And statistics also reveal that those same institutions in the aggregate increased their holdings of money market securities, that is cash-like investments, during each of the past 4 months. So, the problem is that, these, for the most part, I'm not talking about everyone, of course, there are always some good exceptions, but money managers at these big institutional firms, and especially at mutual fund companies, as well as registered investment advisors and stockbrokers, you see, part of the problem that they cause is that they don't want you to get out of stocks. They want you to always be fully invested in the financial markets in some capacity. And the reason being is they don't get paid as much money if you don't stay fully invested. And that's just an outright fact. I don't want to get into the details of that, but let's just leave it at that, because I don't want to get into the specifics. It would take too much time. But I'll never forget, approximately 2 years ago, when I worked for about a year at a major investment brokerage firm, one of the world's larger investment brokerage firms, that one of the very successful brokers at that firm. And what I mean by successful and bringing in a lot of money to the firm and then making a lot of money for the firm and himself. When I approached him one day and asked him, well, based on his education and his experience, which was pretty impressive, why did he not get his clients out of the stock market during late 2007 and early 2008, when a vast number of leading economic indicators, as well as trading statistics, often referred to as technical indicators, indicate clearly the stock prices were likely to fall sharply during 2008. I asked him, well, why did you not get those folks out of these stock mutual funds that you had them in and get them into cash-like investments, money market securities to protect them? He looked me straight in the eyes and said, David, I need to get paid. If I put these people in cash-like investments out in money market securities, I don't get paid when they're sitting in cash. I said, oh my God, what was I thinking? Surely this person was going to place the interest of himself before the interest of his clients. And obviously that's exactly what he did. Now, I'm not saying that everyone does that, quite the contrary. There are folks that out there, whether they're brokers or investment advisors, mutual fund managers. Of course, there are folks out there that take care of their clients and look out for the interests of their clients. But a lot of these folks, either they don't, they're bad at what they're doing, or their decisions regarding the portfolios that they manage suggest that there's a good chance that they're just as interested, if not more interested, in their own financial well-being. And that's not what we do here at Frazier and Mayer Research LLC, the provider of Investors Monitor. I mean, we truly do look out for the interest of our clients and for investors in general. And if nothing else, I guess in a sense you could say, but we're still looking out for our interest by doing that. And the reason being is, see, we don't get paid based on how much money we have that we gather in assets and how much money that we manage. And the reason being is we don't gather assets. We don't manage money. Instead, we simply provide investment research. And through our investment journals, we provide independent advice to persons that subscribe to those investment journals. So, if we give a lot of bad information and bad advice, we would lose most of our clients. So we really are looking out for the interest of investors in general and for the interest of our clients. And we encourage you to go to our internet website at www.investorsmonitor.com and subscribe, if nothing else, to our free weekly market commentary. Won't cost you a penny. We don't ask for any credit card information. All you need to give us is your name and email address, and you can sign up for that weekly commentary, and we'll keep you very informed. And if you would like to get our opinions on individual securities, whether it be stocks, ETFs, precious metals, whatever the case may be, I encourage you to try our Frazier's Strategic Allocator, which you can subscribe to by clicking on the subscription offerings button in the upper right corner of our internet website, and you can figure out what to do from there. You can subscribe to that. You will need to provide a credit card number to subscribe to that service. But if you decide to cancel at any time during the first 2 months of your subscription, we'll give you a 100% refund. Okay, enough about that. This really show is not just trying to sell you our services. It's trying to keep anyone that listens to this show informed. So let me look at a couple quick notes here. Well, once again, we have several indicator statistics that suggest that institutional investors were getting more defensive in their holdings over the past few months, and we're putting more money in cash-like investments. to protect themselves. Why else would they do that? Why else would they add to their holdings in cash-like investments? Well, it's got to be because they were actually, in the aggregate, expecting a drop in stock prices. I can't think of any other reason. So, you got to look at their actions, not just what they tell you, but what they actually do. And if we look at the price and trading action in the U.S. stock market over the past few days, or over the past week, really, we'll see that the trading volume increased when stocks were falling sharply, which suggests that that was institutions unloading their holdings. And yet when stocks rebounded for, 2 or 3 days at the most, I think it was only 2 days, the trading volume was much less and declined on each of the days that the indices rose, suggesting that was individual investors to a large extent who were buying stocks during these up days and not the big institutions. Okay, enough about that. Let's see. So I'm going to direct you to our website, not to subscribe to anything. You decide what's best for you, but to show you where to go for help, to show you where you can go on our website for some helpful information, whether you subscribe to our free weekly commentary or not. And if you go and look at the homepage of our internet website, at the menu bar area, you'll have a gold menu bar, which basically tells you about our services. Then underneath that, you have a burgundy colored menu bar. And if you come over towards the middle of that menu area, you'll see timing monitor. And if you move your mouse down just a little bit and put it over investment environment, and then click on current investment environment, you'll see that once a week, usually on Friday, Saturday, or Sunday of every week, we update the comments on that page. And if you scroll down towards the bottom of that screen, you'll see short-term trading environment. And here's what we told people last Sunday. The current readings on our short-term market timing indicators suggest that U.S. stocks in general will move lower during the week of August 31st to September 4th. Now, so thus far we've gotten that right. And we're not going to always be right, but we've been pretty darn good at forecasting the direction of stocks and at least getting folks in and out of the stock market near the major turning points, whether it be near the major tops or near the major bottoms. We've been very good at that over approximately 15 years now. So I suggest for you to go to that page of our website every Sunday and see what we're saying about what our indicators are telling us about the medium to longer term direction of the market. We have current investment environment, fundamental environment, and short-term environment. And also explore other pages on that chart. I mean, you can click on under that same timing monitor, you can come down and click on technical indicators. You'll get those statistics or indicators we update once a week. And I'm going to leave it at that. You can go through our site on your own. We have a lot of indicators there. So let me just look at a couple of other notes here. Yeah, I'm going to take you back to our website again. If you go back to our website, investorsmonitor.com, and look for the burgundy color menu menu items. Over to the left, you'll see Econ Monitor. No, I'm going to stop there. Please forgive me. Actually, let's come back over to Timing Monitor and scroll down. Put your mouse on Timing Monitor. Scroll down and click on Relative Strength Index. And what that is, that's an index that we construct here at my firm, Frazier Research, where we have a group of 49 growth and cyclical stocks that were some of the better performing stocks since the latest bull market began during March of 2009. Leading stocks, and any of you that's done some reading from some of the better stock market traders in history know that the direction of leading stocks is very, very important. You know, wherever leading stocks are going, the overall market's probably going to go. And if you look at our chart on that page of an average closing price of those 49 growth and cyclical stocks since the most recent bull market began in March 2009, you'll see that the average price of that group of stocks broke through a major price support level approximately a week ago and remained substantially below that level as of last Friday's close. And this is just one more indicator for you to keep an eye on. Once again, the overall direction of stocks. Stocks in general tend to move in some leading stocks. So this is not a little long as usual. I found that these our TV show usually lasts for about 15 to 20 minutes, or at least 10 to 20 minutes. And but one thing I'm confident of is that if you spend 10 to 20 minutes watching our show on any given day, you're going to get much more, or at least you're going to get much more out of spending maybe an hour or 2 hours or even 3 hours watching other financial market shows, reading the major financial newspapers, and I could go on and on and on. I'm very, very confident of that. And it's not because we're necessarily smarter than anyone else. We just do a ton of research, and we look out for the interest of folks that listen to our shows, that read our market commentaries, and subscribe to our investment journals. So I'm going to leave it at that, other than say, I'm confident that stock prices in general, at least here in the U.S., are going to continue to be very volatile and are likely going to continue to trend lower over at least the next several weeks, if not the next few months. So I thank you for listening and watching, and we hope you tune in again tomorrow.